Hey, Scott, how much do you love paying tax?
Yeah, not my favorite.
No, me either. Look, good episode today. We're going to talk about some ways you might be able to pay a little less to the government, but also a few tips and traps, I guess, that people maybe aren't aware of that you should be and maybe what you can do about it.
If you're listening to this podcast and you love paying tax, stop listening. This is the wrong place to be.
Yeah, yep, spot on.
All right, let's get into it.
Beautiful. Look, I'll just throw this out there at the start, get a bit of a boring disclaimer out of the way, but we'll talk about some different strategies here. We'll run some examples. I don't know any of you that are watching this podcast nor your situation, so don't jump straight off and go and do what I say here. General advice only, but it'll give you some things to think about and explore further if anything rings a bell here for you.
All right.
So I thought I might start off with a simple one. Scott, how often do you get asked about salary sacrifice by people?
How many times per hour or how many times per week?
Yeah. It is a bit like that. But I find it's a question I get asked a fair bit and probably something that's kind of commonly misunderstood. Something everyone's aware of, but no one really understands how it works. So look, I thought I might run through a couple of quick examples and just show, the power that can have to help you build your retirement savings, really.
All right. So tell me, should I be doing salary sacrifice? Is that the right thing for me? Should I put money into my mortgage or should I salary sacrifice? What do you reckon?
Yeah, great question. That's another one I probably get asked multiple times a day, mortgage or super. Look, everyone's scenario is going to be different. So there's no right or wrong answer here. It's going to be an individual thing. But what I will say is for a lot of the people we speak to, probably the majority, the tax benefits of salary sacrifice into super are going to be near impossible to beat for, in any other option. If you think about the fact that you're saving, maybe if you pay a bit extra off your mortgage, you're saving maybe 5-6% interest. But, for most people, salary sacrifice to super is probably saving them somewhere in the vicinity of 17% tax for that same money. Massive difference.
Can you just repeat that again? Let's just clarify that, Phil.
Yeah, well, why don't I clarify with an example? All right. Can you see my spreadsheet here? Beautiful.
As you can see, Wealthlab went to a hectic design school rather than having economics and or business backgrounds.
Yeah. Very, very pretty.
For those that are listening in, Phil's brought up an Excel spreadsheet. On the left-hand side, he's got benefits of salary sacrifice, taxable salary, taxable income, Div 293 tax if you're earning buckets, and then the net difference. So just going to be talking us through this document that we look. You can find lots of these on the internet. This is one that we've just generated for this podcast. We have a more detailed one that we use for our personal advice clients, but this is a great example for someone who's watching this and they want to understand about their making salary sacrifice and saving money on tax.
Yeah, I'll just give you a really quick example, and I'm not going to go through 6 million different variations here, but just to give you a very quick example, assuming you're earning $100,000 a year, on the top part of your income, you're paying 30% tax on that. If you were to put that same portion of your income into your superannuation, it still gets taxed, but it gets taxed at a lower rate. It gets taxed at 15%. So this is where the power of salary sacrifice comes in. So assuming you're earning $100,000 a year and you're not doing any salary sacrifice and you're getting standard contributions, your employer's putting about $11,500 a year into your super. You are allowed to put $30,000 a year into your super that carries a tax benefit. So employer contributions or salary sacrifice. So if you're on $100,000 a year, you've got $18,500 additional tax-effective dollars that could go into your superannuation. So to give you a quick look at what that looks like, for argument's sake, just say you're prepared to give up $10,000 a year towards salary sacrifice. I'll plug it into my little little calculator here. So I've got $100,000 at the moment. You're paying, if you're earning $100,000 a year after Medicare levy, you're paying about $22,788 to the government. Great. If I get up $10,000 of my salary, which is $192 a week, now my taxable salary drops down to $90,000. My taxable income, my personal taxable income, has now reduced by $3,200. So instead of paying $22,788, I'm paying $19,500, just over $19,500. Not bad. Now, as I mentioned, it is still going to be taxed going into super. So you're going to pay about $1,500 tax on that contribution into super. But the net benefit there is you've now reduced the tax that you have paid by $1,700. Now, that might not sound huge, but if you think about that over 20 years of a working life, that is massive. Because you've not only got that money every year, but the growth on that money And it's simply by redirecting some of your money out of your pocket to the government. Rather than directing it to the government, you're directing it to your own retirement savings, compounding effect. Yeah, and the more that you put in, if you could max that whole cap and do the full additional 18,500, now you're saving about just over $3,000 a year in tax.
But why doesn't everyone do this? Well, the answer is because you need to go without that money, because what you're doing is you're foregoing that money and you're putting it into your super account instead of taking it yourself. It's still your money, it's still going into your assets balance. But the difference is that you're effectively foregoing that money being paid into your own personal bank account, and that money is being paid into your super fund. And you're getting a tax benefit of, in this scenario, $356 in this one specific pay cycle. And that makes a huge difference from a compounding perspective. But the thing is, you've got to make sure that you're managing your household expenses in the short term for that medium to long-term benefit of the tax saving.
Yeah. And if I go back to your original question, should I salary sacrifice or pay it off my mortgage? If you had a mortgage and you're paying a 6% interest rate on that mortgage, and you paid that same $18,500 off the mortgage rather than into your super, you've saved about $1,100 in interest over the course of a 12-month period. So straight up, you can see it's a pretty significant difference. Now we can start getting...
The salary sacrifice one is better off, just to clarify.
Yeah, just to clarify. Now, there are a bunch of ways, and there's also like a bunch of additional sort of benefits we can get depending on your scenario. If you have less than $500,000 in your super and you have not used your full, it's called your concessional contributions cap, that 30,000 limit we were talking about. If you have not used that full amount in the last 5 years, we can look back over that last 5 years and catch up any of those unused contribution caps. That can end up being an absolutely massive benefit. I think about clients recently that I worked with. They've received maybe an inheritance and they've had a large lump sum of money, didn't know what to do with it. And we were able to put, a massive chunk of that into super and claim enough of a tax deduction that they actually paid no tax at all on any of their income for a year. It's always nice when a client rings up and goes, "Phil, you sure that was legal? This feels too good." And yes, it was legal, and it's just a great strategy. Can be a really great way to deal with capital gains tax. Maybe you've sold a property, you've got some capital gains. We can look back, use that limit, get your large tax deduction to help wash away some of that capital gains tax.
I really like another one of these. So this simple contribution strategy is an example of really effective ways to manage tax. And people say to us, "Look, Australia is such a high tax." It's a high tax country. We've got a few online inquiries about people that have got like crypto, or they want to move overseas. They want to do something because they think, well, I can save tax if I live somewhere else. Yeah, or you can just do a salary sacrifice strategy and save tax and live in Aussie and get all of the benefits of living here with the relatively safe rule of law, the great culture that we've got here, and still have a tax-effective strategy. You just got to do a few different steps, or got to do some more steps involved. You don't have to move your whole family to Dubai to have a tax-effective strategy.
Yeah.
So this scenario here, your net difference is $3,145. Massive difference. Yes, you've got some steps involved. But if you, like Phil said, let that run for say 15 years and let that investment account run over 15 years, this is a really effective strategy that you should be considering doing if you've got the budget for it. If you don't have the budget for it, maybe it's time to sit down and have a look at what you can do to free up a little bit of cash.
And sometimes, it is a bit counterintuitive. A lot of people I speak to, and sometimes I'm suggesting to people, "Hey, reduce your mortgage repayments, put some money into super," and they look at me like I've got three heads, because we're taught all through our lives, get rid of non-deductible debt. And sure, that makes sense. Pay your mortgage off as quick as possible. I'm not telling you that's a bad thing to do. Sure, it's great, but sometimes financially, you're better off to direct that money to super and then rip it out at the end when you retire and pay the mortgage off then. You're effectively using money that you've saved that would have been paid in tax to pay your mortgage off. So it's just a change of the way you think. Now, if we take this strategy a step further too, quite often we come across people that they can't afford to be maxing their cap or using that full 30,000 limit, or maybe they've got a lot from the last 5 years that they can't afford to use. If you're over 60, we can start to look at strategies. You may have heard the term transition to retirement or TTR strategy kicking around. Very simply, that allows us to access via a transition to retirement account up to 10% of your super balance each year. So when you think that through, you can now start to salary sacrifice a higher amount to super that you may not have been able to afford and replace that lost income by drawing on a transition to retirement pension once you're over 60. So you're still working, you've still got the same net income coming into your pocket, but the income coming from your super is tax-free, and you can salary sacrifice from your salary to reduce the tax that you're paying. So there's some really great strategies around this. Like I say, we can't sit here and go through every scenario on the planet, but certainly if you're someone that's not maxing your cap and sitting here thinking about if there's options, in particular if you're at 60, that would be a really good idea to sit down and have a chat to someone around it, because there's probably a lot you could be doing that you're unaware of. I feel like I've done that one to death a bit. Scott, have you got anything else to add before we move on?
Look, this is a great example of unsexy wealth habits. Why boring builds riches. That's the name of this title. That's why we're doing these types of podcasts. If it's shiny, if it's sexy, if it's interesting, if it looks really flashy and like a great money-making strategy, probably not the best thing for you long term. Effectively, the secret to build wealth is to be consistent, have a great strategy, and do a budget, work with yourself to see what surplus income you've got, and then look at the system that we're in. Is it the superannuation? Is it the home loan? Is it another type of investment? And then work with a cash flow, just like what Phil has just used, to figure out exactly what you're earning at the moment, what you can allocate to the investment bucket. And of that investment bucket, if we can put that into a superannuation account, you're going to get the double whammy of the salary sacrifice benefit. And you're also going to get the benefit of having money inside your super account that's taxed at a much lower rate than your personal rate as well. So you're going to get further compounding benefits as the growth within your super fund is at a lower tax environment than it is in your own personal name. So in this example here, that $3,145 is going to keep compounding consistently over the next 15 years. Is that sexy or flashy? Not really. Is it going to work? Absolutely.
Yeah, that's exactly right. And that's the stuff I love about this kind of thing. Like, yes, obviously we do a lot of thought into our investments and how we plan investments and how we invest people's money and all that stuff. Yeah. But markets are going to be markets, and they're going to do what markets do. This stuff is just using available laws and rules that we all have available to us. It's a known outcome. We know if you do this thing, you will get this outcome. So it's certainty, which is great. And just so on that point where you're talking about, and that was a good segue, Scott, into the next thing I was going to talk about, just being in general, superannuation being a really tax effective place to invest. If I've got money to invest outside, or if I've got money to invest, I'm trying to decide outside of super versus inside of super, assuming I've got the available caps and limits and all that stuff to get that money in. You know, in this example, if I'm earning 100 grand a year and I'm paying 30% tax on the top end of my income, if I invest 100 grand outside of super, I'm going to pay 30% tax on my investment earnings from that. If I put that same 100 grand and invest it inside of super, I'm only going to pay 15% tax on my investment earnings. So straight away, I'm paying half the amount of tax on my investment earnings just by holding the money in a different spot. Again, you forgo access to it. You can't touch it till you retire. But if that's part of your long-term wealth building, well, sure, that makes a lot of sense in a lot of cases.
Phil, I think you touched on a great point here. Is you can still rip that money out when you turn 60 to then pay your mortgage off. So it's not like it's lost money.
No.
And I mean, there's a lot of investment calculators you can do, but you know, if your investment is if you can get a higher rate of return than what you can get in the bank, if you can get a higher rate of return on your investment account versus your home loan, there's a certain level, but it's usually above, let's just call it as a rule of thumb, just say 2%. So let's say your mortgage is at 5%, and let's say you can get a return at 7%. Well, it makes more sense to invest at the 7% than at the 5%. If you've got a tax arbitrage in there, which is salary sacrifice plus investing inside super, that further either can push, that it allows you to grow wealth further, or the difference can be less because you've got this tax benefit. You don't have to take that much risk with your investments. Yeah.
And just to throw another cool one at you. So using that example again, I've got 100 grand. I want to invest it somewhere. Do I do it outside of super or inside of super? If I do it outside of super and I sell that investment, I'm going to have to pay capital gains tax on it.
Yeah.
And again, maybe I'll get a 50% capital gains tax discount if I've held it for over 12 months.
Do you want to just work through a quick example? So whilst we've got the Excel spreadsheet, let's say, for example, you've got an investment property and you sell, let's just work it through. Let's say investment property is sold, buying in from investment property, say 800,000, and let's say you sell it for 950. 2 years later, let's say it's been the Brisbane property market, or I don't know, somewhere else that's gone nuts.
Yeah. So in that scenario, we've got $150,000 capital gain.
Mm-hmm.
We'll just put 15,000 there. Yeah.
And this is assuming you've created an investment property. You've gone up 150, great for you, and you're earning, let's say you're earning 100 grand a year yourself, and so let's say your spouse is, between you and your spouse, you've got 200,000 family income, something like that.
Yeah, cool. So I've got $150,000 capital gain on the sale of that property. Now, because I've held it for more than 12 months, I'm going to get a 50% discount on that capital gain. So we're actually only going to be taxed on $75,000 of the capital gain. The way that works, again, pretty common misconception around how this stuff's calculated, but if it's between myself and my wife, basically that 75 grand is going to get split in half. Oops.
21, divide by 2.
Done there. Fat thumbs.
So this goes on top of your income.
Yeah. Now myself and my wife are going to have $37,500 each added to our taxable income for the year. So we're going to pay tax on that money at our highest marginal tax rate. Now, in this example, that's really taken us to the borderline of the 37% rate. But to not complicate things, we'll assume it's
literally has, hasn't it? We've made it complicated on that one, haven't we?
Yeah, we're marginally over it. So there's 135,000, I think. So let's just assume 30,000 for ease of math. So basically, the tax we are going to pay on this 75 grand between the two of us, $22,500 off to the government.
Yeah,
pretty.
So you made a gain of 150, and you're going to actually pocket about 130, and then you're going to pay the estate agent, whatever they get, maybe another 10 grand for that. So let's say the estate agent gets 10 grand. So that's like, again, so maybe you're walking away with maybe 125K in your pocket, something like that.
Yeah. Now, if we had that same scenario, but the investment's within super, we've had it for over 12 months. Capital gains tax within super on asset held over 12 months is 10%.
It doesn't need to be a property. This could be a share portfolio.
A portfolio could be a property, could be whatever. But same scenario, but I'm only going to pay a 10% tax rate instead of a 30% tax rate. So now we've got $7,500 tax bill instead of a $22,500 tax bill.
Yep.
Huge. To take that even a step further, if I'm over 60 and I've retired and I've moved my super into pension phase, which we touched on briefly in the last podcast, my tax rate's actually nil now. So I'm going to pay zero capital gains tax on my investment. If you know a way to get better than zero tax rate on selling your investment, let me know. But I reckon that's pretty good going.
I think the thing is that people just don't really realize that superannuation is a great vehicle for building wealth, and it has got some great tax effective advantages. You just got to be a little patient, and you just got to let the mechanics run with it. And then you're able, there's nothing else, you can't get a better rate than zero.
No,
you've just got to do some steps. You basically have got to invest at an early stage. You got to have a capital gain. So you got to make sure there's capital gains in there. And then you've got to make sure you're of a certain age, and then you've got to trigger it at the right time. And then you're able to basically rip that money out as a tax-free payment to yourself or your family.
Yeah.
All
right.
Thanks, Phil.
I reckon we've done enough about the wonderful taxation environment of super. I want to talk about a few traps now as well. So I'll touch on a few of these briefly. I'm not going to get too far into the weeds because some of this stuff gets pretty complex, but look, I'm going to hit a couple of things that most people I find that I speak to are not aware of and can have really significant consequences if the time comes. One thing a lot of people are not aware of is that if your adult non-dependent children, which is where your superannuation goes most of the time if you were to pass away, if your adult non-dependent children are to inherit your super, they're going to pay tax on it. And most people don't realize this. And so it comes as a bit of a surprise. And most people I speak to when I raise this are not that happy to find out about it either. Particularly if you've got some complex estate planning, you've done some estate equalisation and you're planning on different people getting different amounts, and all of a sudden it doesn't work because the government.
So just touch on what Phil means by estate equalisation. What that means is in some scenarios you've got, say you got two kids, maybe one kid has received more money than the other over time. So then you've actually figured it out so that the other kid gets more money on when you die. So you've just sort of make it even Stevens. That's the official term, the equalisation. That's what that means.
Even Stevens, yeah. That's what the lawyers use, yeah.
Yeah, exactly. Good luck with that.
Yeah, that's exactly right. And then all of a sudden you come to find out the tax office is going to roll up and stick their hand out. So, look, it's something to be aware of. And just to clarify, if I pass away and my wife inherits my super, she's not going to pay tax on it. If my non-dependent children, so my daughters are, 4 and 7, they're not going to pay tax on it. But this is adult non-dependent children. So they're grown up, they've left home, they're away. Or any non-dependent really, but non-dependent children is the most common scenario. So to explain how this works, the way it comes about is that you have two different components in your superannuation. And you're never going to see this unless you're looking, we look at it because we're financial planning nerds and we need to. But the way this comes about is that, everyone has components, underlying components in their super. There's two common ones, which I'll stick to. There's other stuff that I won't bother getting into the weeds because it's a super small segment of the population that'll worry about that. So you've got two components in your super, which you probably never see because you don't care and you don't need to know. As financial planners, we need to know because of some of the stuff we do. But you've effectively got two components. You've got taxable and tax-free. Now, these two components come about based on how the money gets into super. So the taxable component forms any money that's gone in as salary sacrifice, as employer contributions, anything that's come in under that concessional contribution limit that we were just talking about before. The tax-free component comes about through any other money that you've put in. So if I put in some money after tax, like I got $100,000 from somewhere and I chucked it in, didn't claim a tax deduction on it, that would go under the tax-free component. So you have these two components in your super right now. The vast majority of people, almost all of their super is taxable component, and next to nothing is tax-free component in the vast majority of cases. So when you pass away, if your super does go to adult non-dependent children, they are going to pay 17% tax on whatever is in this taxable component. Could be slightly less. Maybe you can avoid some Medicare levy if it's directed through the estate, and I won't go too far into the weeds there. But in most cases, you're going to be looking at 17% tax on whatever's in this taxable component. So to give an example, if I had, for example, 200,000 taxable component and 100,000 tax-free component, again, that's pretty rare because most people are going to have everything over here. But in that scenario, there's a $300,000 inheritance that I want to pass to my children. I've got $200,000 taxable component. My kids are going to pay $34,000 in tax on that death benefit. So now instead of my kids receiving $300,000 as I had planned for, they're actually only going to receive $266,000, and the rest is going to our benevolent dictators at the government. That's a outcome. And what makes it is the fact that most people have no idea that this is going to happen. So 266 grand has come out of the estate instead of the 300 that I wanted my kids to get. I think we'd all agree that's probably not ideal, especially when it comes as a surprise that nobody was aware of. Now, there are things that you can do about this, provided you're aware of them and you take action at the right stage. And it's a bit of a niche area, a bit of a specific time frame that you need to take action in. But thinking through some of the things we were talking about earlier, like being able to withdraw from your super from age 60, or once you retire, being able to withdraw from super, but still being able to contribute to super prior to age 76. That gives us a window of time where we can now start thinking about, is it possible for us to pull some money out of super and then put that money back into super? Because obviously we want to hold it in super, a more tax-effective environment. As dumb as it sounds, what that does is when we withdraw it, the money is coming proportionally from these two components. So in this case, 2/3 is coming out of my taxable component, 1/3 is coming out of my tax-free component. All that money comes to me tax-free because I've already paid my tax on it. I'm over 60, any withdrawals are tax-free. Now, if I take that same money that I've just withdrawn and I put it back in, because I'm not claiming a tax deduction on it, it is now going to form all tax-free component. So if there's an opportunity over a few years to do a number of withdrawals and contributions back to super, I can now turn this $200,000 taxable component into a full $300,000 tax-free component, thereby reducing this to zero.
Yeah.
Again, there's a lot of rules that pull together to make this strategy work. Don't just go blindly and start ripping money out of your super and throwing it back in. If you get it wrong, it's going to come with penalties. You're going to blow contribution caps, all that sort of gear. Have a chat to somebody if this is something that's important to you. But I just wanted to call it out because a lot of people are not aware of it, and it's a bit of a thing, in my opinion. So there you go.
I like that strategy. I like the strategy a lot. You got to engage the family members too. So that's always a good one when we're doing that. The only thing is you also got to be consider in these scenarios, and this is something for yourself. If you're watching this YouTube clip or you're watching this is obviously not your case yet, but it might be for your mum and dad. You'll be mindful about their capacity. So you got to make sure that they have the capacity to sign documents on their behalf. And you've also got to ensure that they really aware of what they're doing. If not, you've got to have the power of attorney signed where you can sign on their behalfs. It's a tough process to navigate because you've got competing elements here. You've got the healthcare, you've got aged care homes, you've got family members that may be in different states, you've got money that you're not quite sure about what's going on. And here you are now having to get a document signed that you're now signing. So now you've got what's called a power of attorney, meaning if mum or dad doesn't have capacity anymore to make signatures, now you're doing this sort of stuff on their behalf. And it's freaking hard to navigate that. So the advice from us is slow everything down. Either write everything down in a single document, be really organized so you can just have key contact points. Sort of, this is the local hospital. This is the aged care home that mum's in. This is the accountant that dad used, but I don't really like anymore. And I've moved it to this one. This is the financial planner who's helping with this. It's this scenario at its knife point is very important because in this scenario so it's like 300 grand of funds. You don't want to lose 17% of it. But sometimes people just go, and then bang, and then the tax is payable.
Yeah. And look, realistically, this is the stuff, we shouldn't even be discussing this kind of stuff by the time you're 90 and sitting in an aged care home. This is what you should be doing at 60. These are the conversations you need to be having in preparation for your retirement.
100%.
It's not a great conversation to have, and I don't love bringing it up with clients. Hey, you're about to retire, super exciting. What about when you die? But we need to plan for it now. You don't want it to catch you too late. And I'll just, I'm mindful that we've been talking a long time for probably about some pretty boring stuff, but I'm going to hit the last one really quickly. Again, this one's pretty complex. I won't get too far into the weeds, but I like to call it out because it catches people out and it catches them out all the time. Most people that I speak to around insurance, the default thought process is, I've got total and permanent disability insurance in my super. I have some cover in my super. If I become disabled, I can be paid that. I can be paid my super. Going to be sweet. Where people get caught out is they do not realize, and this, in my opinion, is extremely miserable, but if you are paid a total and permanent disability payment from your superannuation under the age of 60, it's taxable. So you've done the right thing. You've got a mortgage. You go out, you take out enough cover to make sure your mortgage is cleared. So if you become disabled, your family's taken care of. You become disabled, and then the government comes and sticks their hand out for a chunk of your disability payout.
So just work on the maths, Phil. Let's say I have a $300,000 disability payout. Let's say and you got to be, this is the test that I like to say, you're basically a potato. You've not slipped and fallen, broken a leg. You've broken both legs. You are completely, totally and permanently disabled. So you're incapacitated. Spinal damage, double leg damage.
Mental health's a massive one.
Cognitive impairment.
Heaps of stuff. Now, I'm not going to go through a worked example on this because the complexities and nuances to how this is calculated are way beyond the scope of what we can go through right here. But I'm going to hit some really key points. When you get a TPD payout, total and permanent disability payout from your super, again, it's applied, the tax is applied based on those taxable and tax-free components that I was speaking about in the previous example. So you're only going to pay tax on the taxable component. Anything in the tax-free component is going to come out tax-free. However, you can't dictate which bucket you draw money from. The money is drawn proportionally out of those two buckets. So if you've got 90% taxable component, 10% tax-free component, that's how it's coming out. You are going to pay, if you just withdraw the money straight out as a lump sum, you're going to pay 22% tax on anything that is in the taxable component. Now, they will apply a tax-free component uplift as a formula based on how long you've been working and blah, blah, blah. I'm not going to get into that. But you get an uplifted tax-free component. So it will reduce the taxable component a bit, but it's still going to be pretty significant in most cases. So straight away, you go and pull 100 grand out of your super. If it's mostly taxable component, you're going to pay, somewhere around 18 grand tax, just rough numbers. There are different ways that you can access that money. Taking it as a lump sum withdrawal is not your only option. You can choose to take it as a pension payment. pension payments are going to be taxed at your marginal tax rate, but they carry a 15% offset, which means that now we've got a really cool opportunity to actually try and balance any money that you may need or any income that you may need between lump sum withdrawals and pension payments to optimize for the tax. Right. And in some cases, you're just going to need a lump sum of money and that's going to be that. But in a lot of cases, we can plan this out, stagger it over financial years and all sorts of things and take the payments in different ways to minimize the amount of tax you need to pay on your total and permanent disability payments. You also need to be super, super careful here because if you're on a disability pension from Centrelink and we go and tip your superannuation into a pension, that becomes an assessable asset for that disability pension. And you could wipe your pension out by doing it or significantly reducing it. I don't want to get too far into the weeds because it is so individual. It's based on your age, your working life, your balances, your components, all that stuff. I can't really give a good working example there without getting too deep into the technicalities of it all. But the amount of people I speak to that get a TPD payout, they rip the money out, they pay their mortgage thinking they're doing the right thing and stitch themselves up with a whole bunch of tax they didn't need to pay. It happens all the time. And I've worked on more TPD cases than I would like to think about over the course of my career. It's actually horrible how many people I've had to help through that stuff. But we can get significantly better outcomes by proper planning. So I'm not here to tell you what you should do in that scenario. I'm here to say be aware of it and be aware there are things you can do about it and you can manage it better. So don't blindly just fill out the paperwork or even worse, pay some solicitor to fill the paperwork out for you. Get the money, rip it out, pay your mortgage and be done. There's probably a better way.
Yeah, you'll see a lot of companies advertising for TPD claims assistance. You don't need to pay 30% to someone to fill in a form. You can do it yourself and keep that 30%.
The claim anyways.
Yeah. Gets crazy. That's a super. I don't like how they operate at all.
Well, that's it. I think we've gone to school enough today. Look, this is the tip of the iceberg, really. It isn't the be-all, end-all, but it does give you a few ideas of a few different A, strategies and B, tips and traps. So hopefully that's been of some help. But as always, reach out to us with any questions and hit us in the comments with anything else you'd like us to cover in a future episode.
Thanks, guys. Speak soon.
Cheers.